Hey, everybody, this is David Pohl, the host of the Capital Stack podcast, where we talk to investors, entrepreneurs, founders about all things value creation in early stage companies and startups, mostly in technology. Today, I am talking to Vik Thaper, who is the managing director of Cypress Growth Equity, which is the largest and most experienced royalty-based growth capital investor in the United States. Since the formation in 2010, they have completed dozens of multi-million-dollar royalty investments in software and tech-enabled service companies with more than 150 million of capital under management.
Pretty good. Thanks,
Now
David, for
working
having
on
me
their
on.
Fund
Was looking
4.
forward to
Vic,
this.
how you doing, man? I'm super excited to talk to you because this royalty-based financing, you guys were kind of like one of the
We were
first
definitely
guys to
early
do it in the
on.
United States, right?
My partners, who are the founders of Cypress Growth Capital, Bart Goodwin and Ed Mello, sort of came across a gentleman out of Boston who's sort of known as the father of royalty. Um, and he was doing this, but with early stage businesses, sort of startups. Writing $25,000 checks, $50,000 checks. His name is Arthur Fox. He's on our website. And so he's sort of known as, all things royalty. And Bart and Ed cold called him because they sort of liked what they heard, and thought that this was something that could be a big thing. And cold called him and then went to raise a fund with this strategy, but with companies that were bigger. So writing $1 million, multi-million dollar checks and companies doing multi-million in revenue, while Arthur was writing smaller checks into smaller companies. So we took what he did, and sort of enhanced it to be more, Series A-ish, if you want to call it that. And he's on our website, et cetera. And so they started that in 2011.
That's awesome. So you gave an homage to Arthur, kind of like the
I
Arthur
guess so. I
Rock who
didn't know that,
invented
but yeah, I guess
venture
so.
capital. It's like everyone's an Arthur in this business.
Wow.
I just read Power Law, which is like the history of VC. So I'm going to sound smart for about 3 weeks, and then it's just going to die off as my brain
Yeah, I mean,
cells, continue to deteriorate
people have been
and I
doing
get new
royalty
information.
forever, right? In mining, in pharmaceuticals, oil and gas, music rights, but as a form of late stage venture is sort of the uniqueness of our strategy, right? There's not many, if any, doing that. Still to this day, we hear people tell us they've never heard of this before, and we've been doing it for 10 plus years and made 80 plus investments into 45 companies.
Yeah, I see like early stage credit guys, they try to
Yeah,
do it and then they just revert to doing
which
term and lines of
dependent
credit.
on the aspects of that facility can sort of stifle growth, right? So it sort of depends on the devil's in the details in that regard. So yeah.
Right. So why don't we dive in, Vic, and tell us a little bit about your background and how you came to be an MD at Cypress, and then I'd love to kind of dive into the whole Cypress model and
Yeah,
how
happy
that fits
to.
into the capital stack, which
So
is
a
the name of
Dallas
the
guy,
show.
born and raised here. The early part of my career, I was a consultant, so did technology consulting for about 10 years. And then business school is where I sort of got my first interaction to venture capital and private equity, and really enjoyed it, liked it, went all in. After school, I joined a venture capital fund called the Emerging Technology Fund. It was a state of Texas venture fund. So it was working with the government to invest in early stage companies. So I sort of covered North Texas. So if you were an early stage business, software, life science, energy, whatever, and you were based in North Texas, you would come through us if you were looking for venture capital funding from the Emerging Technology Fund. So I sort of did that for about 3 or 4 years, and did a number of investments in early stage companies, and learned a lot. So I learned a lot as a consultant, learned a lot in business school, and then I learned this was sort of like a second business school to me, because I worked with so many early stage businesses in so many different industries, that I really got a crash course in venture. And the folks I worked with used to be venture capitalists, and they sort of retired, but they still wanted to give back. So I had those folks around me and learned a lot, and sort of collaborated with entrepreneurs, service providers, and investors. So I got to spend a lot of time with all three of those types of constituents. And then I was lucky enough to meet Bart Goodwin and Ed Mello when they were early on starting Cypress Growth Capital. So I met them in the 2010 timeframe, 2011 timeframe, and we just got better acquainted. I would see a lot of deal flow at the Emerging Technology Fund that were better suited maybe for others, and so I made introductions to Bart and Ed of a few companies that they then invested in. And then we got to know each other better through that experience. And then in 2012, I decided to make the leap from the Emerging Technology Fund to join Cypress Growth Capital. And then over the past 10 years have elevated into the firm. So it's been great. I think they had made 4 investments when I joined, and now we're at 45 portfolio companies, of which a number have exited, but that sort of tells you the trajectory. We're at Fund 1, 4 companies. Now we're at Fund 4, and we've made
Wow.
investments in 45 different companies. No, we
Wow.
have
So 45
probably, I
active
think we have
portfolio companies.
23, 24 active portfolio companies. The rest have exited in some form or fashion, um, which 90% of our companies, sort of with our capital, the next stage is a growth equity round. So they use us sort of as a bridge to that next growth equity round, or strategic sell or PE recap. So those are sort of the 3 areas we tend to feed into. Not every time, but 90% of the time, that's where our companies end up going.
Yeah, and I want to talk to you about the structure of that in a little bit, but I'd love to kind of talk about your transition to VC into royalty base, which
Yeah, it
was
was definitely.
new
I
and
mean, you're talking
emerging.
to
And what was
companies
that
that have no
transition like?
revenue or aspire to have revenue to companies that have revenue. In my world, we invest in companies once they have 2 or 3 million in revenue. So you can talk to customers, you can see a product demo. There's just a lot more there, even though they're still pretty young. On the venture side, you're looking mostly at the team, the market, and your confidence in them, taking X amount of dollars and getting to some level of revenue. So it's much more difficult, obviously, in picking those seed stage, pre-seed stage winners. Then in my case, at least I have some metrics I can look at, some customers I can talk to, somewhat of a team that is in place, right? Now, I'm not saying it's going to be a 10-person management team, but there's typically 2 or 3 people. In my case today, while back then, an earlier stage, you may have 1, you may have 2. Hopefully, you have 2, but it's definitely assessing things much differently. But the rewards are different, right? The risk rewards are highly different on a pre-seed and seed versus the stage I'm investing in, which I would call more Series A.
Hmm. And so tell me, what is, how is the fund thesis? What is the fund thesis or the
Yeah, I
firm's
would I would
thesis, and
say,
how has it
we
evolved
haven't
from fund 1 to fund 4?
changed things up too much. Um, the thesis, generally speaking, is to invest in only B2B companies that sort of fit in 3 buckets. The first one is the SaaS tech enabled service bucket, which is where most of our investments have been. But we've also done a number of successful investments in the managed services, which is recurring revenue businesses, but maybe less software. And then we've also done a number of investments in sort of niche professional
Hmm.
services, which obviously is no software. But given our backgrounds, we feel like we can assess those. And we've done a number of successful investments in those 3 areas. So the types of businesses we invest in has been the same since day one. That's sort of been our strategy. That's our background. So we definitely can help those companies. But also those companies, the companies we're investing in are doing more with less, where they have not raised 5, 10, 20, 30 million in capital. They might have raised a couple of million to get off the ground. They sort of bootstrapped their way to a certain degree, and now they're looking for capital to sort of fuel that fire. So we're sort of the first sponsored round, I guess, if you want to call it that. Prior to us, it might have been a seed fund or maybe an angel fund or family office, friends and family, things like that. And then we'll come in with the sort of the first institutional capital, I would say, to help them get themselves to the next level. So I don't think our thesis has changed much besides our geographic focus has expanded. Early on, it was sort of Texas, Colorado, Arizona is where we spent the bulk of our time. And then we've sort of expanded to other markets like the Carolinas, Georgia, Tennessee, other areas that I would say are similar to Texas, Colorado, and Arizona, where we originally started to invest.
Awesome. That's really awesome that you were able to kind of knock what you wanted to invest in and why pretty early. There's nothing an LP likes more than, when you go up to them in Fund 4 and they say, "This is what we learned in Fund 1." And,
Yeah, and
things
our LPs
drastically change
appreciate
and
we're
you
investing in
learned on someone else's
companies
dime.
that we know, given our backgrounds. And then entrepreneurs want value-added investors. They want folks that'll bring more to the table than just capital, and our backgrounds speak to that. And so that helps us when we're sourcing and picking the companies. But then also it helps on the other end when they take our capital and they're looking for more than capital to help them go from 3-4 million to 10 million. So it helps on both fronts.
So tell me, how does the deal structure work for anyone who's never heard of revenue-based financing
Yeah,
that is
so
looking for a different option
so
besides
so we
equity and
sort
debt?
of coined the term royalty-based growth capital. It is a form of royalty-based financing, RBF. But the way it works is our sort of criteria is, check size is 1 to 5 million into companies doing 3 million to about 15 million in revenue. And the way it works is we make an investment, and starting the next month, a royalty would kick in. That royalty is somewhere between 2 and 5% that's paid monthly until a cap is hit. Once that cap is hit, then the obligation is over. So if you believe in your equity, believe in your company, you feel like if you got 1 million or two and put it towards these initiatives that you can really scale your business, and you are looking for help, then it's the obvious choice than going down the dilutive path. It's in your best interest to maybe delay that for 12, 18, 24 months. Because if you can take our capital and grow from 4 to, let's say, 7 or 8, or even north of that, it just makes sense all around. Because the value of your company, the pie has gotten so much bigger. And if you raise a round of capital later on, you're giving less of a piece of that pie. The earlier you raise, the bigger the pie you give up. It's inherent, right? So if you can kick that can down the road a little bit, you have to raise
Hmm.
seed capital, right? So you get that seed money in the door, but if you can kick that Series A down the road or avoid it and go straight to growth capital, there's something to that.
Or you could never sell any of your company and continue to pay off the 2 to 5% until the cap and
Yeah,
own
I mean
100% of your company and
that
not have
happens
somebody up your
pretty
ass on the
frequently
board.
where, like I mentioned earlier, our companies take our capital and typically three different things happen. One of them is a growth equity fund. The other one is PE recap or strategic. And in that case, they're selling all of their company or more than 50%, which means they have a nice liquidity event, right? The management team, the founders, and the early shareholders sort of have a nice liquidity event in the case of a PE recap, but then they get another bite at the apple, right? So to your point, yeah, they can take our capital, go straight to an exit,
Hmm.
and their financial outcome may be exactly the same if they would have raised growth equity, but because of that, they might have to they may have to exit at a much bigger valuation, which may get them to the same outcome, right? But it sort of depends on their path,
Hmm.
right? There's no either one could work for us, growth equity or not. But in our case, we're just telling them just kick that can down the road, decide later.
Yeah,
That's right.
yeah. As long
If
as
they're
they're selling, it
selling,
really
either
doesn't
path will
matter.
work, right? If they want to do an all-out sale, that works, or if they want to do a growth equity because they're creating additional value. And honestly, because they really haven't raised much capital and they take our capital, put it into sales and marketing, they've proven to the next investor, look, I got 1 million or two from Cypress, put it into sales and marketing, and look what I accomplished. I haven't had the ability to put a lot of capital towards sales and marketing. I did that now, and look what the end outcome was. And then I think just inherently, if you tell somebody you're doing whatever you can to avoid dilution, that really tells somebody how much you think your company is worth today and what it potentially could be worth down the road. I think, there's something to hearing that out of an entrepreneur's mouth. Oh, of course. Yeah.
Yeah, it's a
And that's what we
positive
like to hear.
signal.
We want to hear people that really believe in their company.
Yep.
Those are the types
So,
of entrepreneurs we want to invest in.
right. Yeah, it's like there's nothing worse than an entrepreneur who gives you a budget and they say, okay, well, if you miss the budget, we're going to do a valuation
Exactly.
adjustment. They're like, wait, what? And I was like, you gave me the numbers. I didn't, like I didn't make this up.
That's right.
So if you
That's
don't have
right.
conviction in your numbers, that's a pretty bad signal. And so how long does a company usually
Yeah,
are they with you
yeah. I
before they go
mean,
through one of these three
typically
doors
2 to
or
3
hit their
years is
cap?
where it ends up shaking out. Not, I would say that's where most of them shake out. Some earlier, some later, because some sort of positive outcome occurs then. One of those three things that I mentioned earlier. So I would say in the 2 to 3 year mark, they have some sort of liquidity event or growth equity event, something of that nature. But they can go 5, 6, 7 years. I mean, it sort of it varies, but I would say the bulk of them are in that 2 to 3 year mark.
Hmm. And then, like, when you come up with that cap, you essentially say, okay, this is what the capital is. This is what I mean. How do you? I'm not asking you for inside baseball and the actual numbers, but how do you think about making your cap your cap? Do you just say, okay, like I know what I need to make for my investors to what I told them, and I need to back into that number, or do you think about, okay, the cost of capital for equity is this, the cost of capital for debt
Yeah,
is
I
this, and
would
we want
say
to play
it's
somewhere in between? How do you think about
the
that?
quality, I would say it generally shakes out to how the company's doing, how much capital are we providing, how fast do we think they're going to grow, things of that nature is what ends up shaking out on what is the royalty rate, what is the cap, things like that. So just the dynamics of the business.
Yeah, so there's just so many qualitative and
I would say it's
quantitative
very similar to
aspects to the
venture, right?
business
When
when
you're
you
making an
underwrite it to
equity
come up with those
investment,
levers.
it varies deal by deal. The management team, the market, the product, client concentration. You just, when you're assessing a business, no matter if it's me or if it's you or a growth equity fund, you know, all valuations in an equity world are not the same, right? So it just has to do with the characteristics of the business, I would say.
Hmm.
When we look at them all, it's not just the financials are just one aspect
Hmm.
of the company. There's many other aspects of the business that are equally as important to the financials. But the financials obviously are the starting point to a certain degree,
Hmm.
just given our criteria that we have. Yeah,
And is there
typically there is
any
a small
warrant
warrant
coverage on the
that is
financing?
involved. So yeah,
Okay, so
yeah, and I
so
would
you can
also say
participate
we
in the
do
upside
equity
as a
investments
partner for
alongside
taking the
our
risk.
royalty as well. So we are capable of
Oh,
doing
nice.
royalty and then equity alongside it, or equity following a royalty investment. We've done that on a few occasions as well, where a company has taken our capital, grown, and then we have helped them. They've gotten to know us, and now they're raising a true growth equity round, and then we come in and participate or syndicate with somebody else. So we've done that as well. So that tells you a little bit about the companies we're picking, and they're wanting us to come in that growth equity round as well.
Hmm. And so when you go and pitch royalty based financing or royalty based growth capital, as you coined it, are you competing with other people that do what you
Yeah,
do?
I
Or are
mean,
you
there's definitely a
competing with
form of
equity and debt? Or are you
competition, not
competing
on
at
every
all?
deal, but on deals. And in some cases, it's do nothing, right? The entrepreneur decides to do nothing because they tend to, because they haven't raised a ton of money, they sort of, they then get profitable or stay break even, right?
They can get
But
profitable.
at the end of the
Yeah.
day, the entrepreneur needs to decide: do I want to go down the path of raising equity and facing dilution, et cetera, or not, right? And once they've made that decision, then there may be other folks like myself in the conversation, and sometimes there's not. Oftentimes there's not, because the entrepreneur is looking for more than just capital. So they're looking for advice, board level advice, things like that we bring to the table. So it varies, but there's always some level of competition, right? No entrepreneur is going to pick one investor and move forward. And it's very rare. They definitely are going to talk to a handful of folks and then determine
Hmm.
what is the best type of capital and then what is the best type of partner, I would say. Because there's more to a firm than just the capital.
Sure.
We do not take a board seat.
Now,
So
do
the
you take
control
board
remains
seats?
as is, but we do the things that a good board member would do. We help our companies in that way. But the control,
Hmm.
that's right.
Yeah,
And
you
I
don't
think
need
our
to be a
entrepreneurs
board member
realize
to be
that
a
with the
value add.
conversations we're having with them prior to an investment that, these questions may be a little different than you might get from, a bank or a mezz lender or something like that. It's more financially oriented
What kind of questions would
versus
those be?
asking about, sales
Yeah.
process and competition and other aspects of the business versus just the financials.
Mhm. Awesome. Awesome. So you've expanded nationally. So what is your deal sourcing strategy? How do you go
Yeah, I
out and
think
put yourself in
because we've
front
been
of
doing this
people
for
and tell
10
people
plus
your story?
years, and we tend to focus on a handful of markets. We get to know those folks in the market. Um, and as they come across opportunities, they tend to remember us. And then we get introed in. So it's sort of the channel approach, I would say, is sort of where most of our investments occur. And then as we make investments, we announce it to the world. And then we tend to get, another round of prospects, and then we just move that down the funnel. So, obviously being in Texas, having done a number
Hmm.
of investments in your backyard in Arizona as well as in Colorado, people tend to get to know us or hear about us, and then we get deal flow from partners, which are growth equity funds and senior lenders, accounting firms, law firms, folks like that.
Uh,
So even though we're an alternative to equity, we get quite a bit of deal flow from equity because we feed into it. And then we meet companies that are a better fit for equity and vice versa.
right. And there's
That's
not
that's
every
right. So there's
business is
plenty
a
of
venture
businesses
backed
that may not
business,
be a fit for venture,
right?
and
That
there's plenty of companies that are a fit for venture and a fit for us. So the companies that venture would love to get into, we can do, but the entrepreneur is looking to sort of not do venture or equity today, right? So we can sort of invest on both sides of the coin. And so if an entrepreneur is talking to an equity investor and the valuation is too high or they're really not looking for equity, we oftentimes get deals referred to us from Series A investors. It's very competitive and collaborative, just like it is in the equity world, where they compete
that's
with each
great.
other and they syndicate. So we're sort of the same thing.
Hmm.
Uh,
Any outbound strategy?
no, not really.
Yeah, are you banging phones at all or
We
doing emails?
we email companies we hear about and we come across. We don't make phone calls. We do I would say it's a little bit more thoughtful of an approach, if that makes sense. We're a small team too. Like there's six of us in the firm. So we're not one of those multi-hundred-dollar funds or billion-dollar funds. So it's a little bit of a our approach. We can talk to a lot of companies or we can invest in a wide variety of companies, but we tend to invest in 2 to 3% of the companies we talk to. So it's a pretty focused approach on the quality of companies.
Yeah, you might not have
We
a
do,
50 person
and
deal
it's very
team, but you
popular.
do serve
So
Topo Chico in your office.
then the large size as well, as you noticed. Yeah, Ryan, our
Yeah, the large
analyst, is
size,
a
which I didn't even
big
know
Topo
existed. I
Chico
mean, it just
fan,
blew my
so we want
mind.
to keep him well hydrated.
Yeah, we buy up the stock. We'll buy literally like 2 months at a time and just clear out the store.
Yeah, and
Like
I think
we buy
Topo, at
Topo
least in
Chico like
Texas,
people
I
bought
think is
toilet
hard to
paper in
come
the
by from
pandemic.
time to time. So exactly.
It's
So
because
they,
it
they
doesn't make it
stop
past
stop with
Arizona.
you.
Like the trucks don't go that far. So, what are you excited about? How are your feelings about the market? Kind of
Yeah, I mean, I think
how do you
the
see the next
as
couple
it's no
years going for
surprise
you?
the valuations have been high the last couple of years. Valuations have already come down drastically in the public market, and the private market has followed. Just as the market valuations increased in the public market, the private market followed suit. So now Valuations are coming down. We've done our fair share of deals, even though valuations are high the last couple of years. I think as valuations come down, you know, opportunities for us will be even higher. So we're sort of going to capitalize on this recession that seems to be that we're in or soon to be in. So we're going to deploy capital into some good companies. Um,
This is
yeah,
a
I mean,
great
you know,
opportunity for this is like your Super Bowl. Not in a bad way. It's just, companies just, they need more time and they need more
yeah, and
runway
so I
to
mean,
grow
if
into
a
the
company
valuations
raised a
that were set.
considerable amount of capital at a pretty high valuation, that you've probably you're not a fit for us. You've decided to go down the equity path, which there's nothing wrong with that. That's just a path that doesn't work for us given our investment strategy. So if you were toying with the idea and don't want to do it, then you're a great candidate for us. So I think that's where things will become busy for us is a company that thought about going down the equity path, but valuations have come down and want to kick that can down the road or avoid it altogether. I think that's gonna fill our pipeline up. So I'm excited for the next couple of years. Yep. We
That's
closed
awesome.
Fund
That's
Four
awesome.
a
And you
year
just
ago, so
closed
May
Fund 4?
2021. So we're a year in. We've made four investments out of that fund. Have a pretty healthy pipeline. So yeah. So we're meeting a lot of good companies, traveling to markets like Arizona, and excited about the next 24 months.
Awesome.
You have your own
Why
fund,
didn't you
so I
hit me up for
figured,
Fund 4?
we could collaborate as you could be a feeder into us, right?
Yeah, but I wanna taste some of that sweet revenue-based finance
Yeah,
returns.
no,
I mean,
our LPs
that's
are
a good
happy,
that's a
of
good
which we
asset
have
class.
some out of Arizona. But yeah, no, definitely we'll hit you up in about a year and a half, if not sooner. But yeah, our LPs are
Yeah.
happy, and like you said, we're investing out of our fourth fund. Um, and our companies benefited with the high valuations the last couple of years. So the companies that are in our third fund, there were a number of exits that came out with growth equity or strategic exits, et cetera. So when valuations were high, deploying capital is harder, just generally speaking, but it definitely benefited our companies in Fund Three if they chose to go through an exit, and the decision was entirely theirs, right?
How is the fundraising journey from being a government-backed, balance sheet on your earlier career to,
Yeah, I
having to
mean,
sing for your
we're
supper
sort
every
of
3 years
blessed
or
that
year and a half?
we have a good LP base, a diverse, good LP base that is happy that we spend a good amount of time with. So, knock on wood, fundraising was efficient, went well for Fund Four. It's definitely different than my emerging technology fund days because that was sort of just an allocation of capital, right? Governor Perry sort of allocated X amount of dollars, taxpayer dollars, to go towards investing in startups. So there was no raising funds from that standpoint, but deploying the capital obviously was harder because it was, you had to go through the process of the state of Texas, right? Where it can slow things down, can take a little while to get an investment from the state of Texas. Just
Yeah,
Oh, it was
which
much
may or may
slower. It
not be
was
as,
six,
like,
nine
as slow
months,
as a normal
right? To
VC,
get an
right?
investment from the state of Texas could be
Yeah,
elongated if,
yeah.
for a variety of reasons, just because they had a lot of check marks they had to do. So there was a lot of pivots in an early stage company in 6, 9 months, right? So, um, fundraising was easy when you were working for the emerging technology fund because it was just an allocation of capital. But deploying the capital can would take a lot longer. Being a private fund and having healthy returns and good companies that we pick, we have a good LP base that is happy, and fundraising Fund Four wasn't long and drawn out, thankfully.
How has have you gone the
Yeah,
institutional
our
route, or are you
LPs
still doing family
are
office and high net worth?
entrepreneurs that we invested in and that have had a liquidity event. So it's a nice
Oh,
circle,
cool.
right? We invested in them.
Nice.
Yeah, exactly.
That's
As
a
well as
great
family
that's great
offices
validation.
and entrepreneurs that we've gotten to know over the years. So it's not really institutions at this time. So yeah,
Awesome. Great. I went to a institution conference here in Arizona, and heard these guys kind of speak about talking to fund managers and how they look at things, and I just walked out of there like I got punched
yeah,
in the stomach. Like, these guys are so hardcore. I think there's a long road before you get to that level, because they're writing 50, $100 million checks,
yeah.
and
And then they're
their
managing
level
billions of
of risk
dollars, right?
tolerance is
So
not
it's all
high.
about asset class, things of that nature. So we mostly have family
Hmm.
office, et cetera. That's sort of our LP base today.
Yeah, what my biggest takeaway from Texas was just how open and friendly the capital community was with each
Yeah,
other
old Parkland.
in Texas, basically in Highland, Old Highland.
Yeah, the
Oh,
Crow
Parkland,
family,
sorry.
Harlan
Yeah,
Crow's
Old
done a
Parkland.
phenomenal job of creating a campus, a community in Dallas of investors, family office, private equity funds, angels. I mean, you name it. It's a really impressive community, not only from the look and the feel of old Parkland, but the tenants. We collaborate really well with folks on campus. So Mr. Crow's done a phenomenal job of building what he built, but more importantly, getting the folks there, and really creating a community. That's not easy to do, and he's successfully done that and continuing to do that. So we're really blessed to be at Old Parkland and collaborate with the folks that are there. You saw it firsthand. Your cousin's there, I think you said. Yeah,
Yeah, it's
I
kind of
wouldn't
like
call it.
Hogwarts
I
for
wouldn't
rich
probably
people.
point at that. Um, but yeah, but it's a great community and it's
Of
very
course, you get kicked out.
collaborative with a lot of thought leadership. So yeah,
Yeah.
it's definitely higher end, but nobody makes you feel that way. Is sort of what I've seen. So,
No, no, definitely not. But just the old feeling of it, right? The old kind of like
oh yeah,
university,
it's incredible.
architecture and art is just it's incredible. Vic, Vic, I want to thank you so much for coming on to the show. It's been an absolute pleasure.
Yep.
Hopefully, I'll get you on. I've got a couple quick canned questions for you.
Oh,
What
that's
is
a
your
good question.
favorite book?
Come back to me on that one.
Ooh, yeah.
No,
Hmm.
in like 2 minutes.
Okay, like
Once you get back,
tomorrow
I got
or
all these books right here. So,
okay.
um, so
All
yeah,
right.
so come back to me. Yeah, I
Best
would
piece of business advice you've
say
ever
I learned
received.
a lot in business school, the importance of networking. So I would say the best business advice I was given was learn from others, give back, don't expect anything in return. Um, that's sort of the advice I received over my career, and I um, give to others is be respectful to others, but help them. Don't expect anything in return. But most oftentimes you get something back in return, even though you're not expecting it. So continue to network and help others. That's sort of
Goodwill, yeah, goodwill goes a long way. I had to learn that
yeah.
the hard
I
way, but
would I
it's
would say
definitely better to be the good guy.
that's very true. And it's the way the world should work is helping people. Even though I talk to entrepreneurs every day that they may not be a fit for me,
Hmm.
for a variety of reasons, but I always try to come up with a way to help them at the end of the conversation. And I think the other sort of mantra I live by is like respond to the email. You get an email, unless it's obvious spam, etc. Respond to the person, and if it's not a fit, tell them no, and maybe at a high level why, without sort of doing it in a bashing way or a negative way. Sort of constructive criticism, but don't leave them hanging. That's bad luck, bad look. And I
No,
and,
yeah,
and
it's bad
entrepreneurs
luck.
sort of at the end of the day, when they don't hear a no and they haven't received a response, they think there's something there. So I think it's really important to provide feedback. and help people. So yeah. Um,
Awesome. Cool, man. Well, it was great talking to you.
Good
What's
to
your favorite
great is
book? You're
great. I
not
mean,
getting
there's so
off that
many
easy.
that I read and so many blogs. It's really hard to say. That's why I have so many books around me. But I just like reading business books, entrepreneurial books, to be honest with you. Hearing
What was the
the
last?
last
What was the
what?
last good one you read?
I don't
The
know,
last
man.
good one you
Let's
read.
I think I'm more the podcast, hearing the entrepreneurial journeys. Um
Okay.
I like
Yeah. What
the
podcast do you like? What blogs do you
guy
like to follow?
uh what's his name? Guy interviews all the entrepreneurs on, what went wrong early on. Every entrepreneur thinks it's sort of the just because of because of media, they feel like to get to a successful entrepreneurship, to be in a successful company, sort of like this. But that's not the case at all. So hearing,
Mm-hmm.
the ups and downs of entrepreneurism, I think is important. So all these podcasts that sort of interview founders and them being very transparent about, we almost ran out of money, but we signed this contract, or my investors were willing to give me one last pool of capital. I mean, I think those are the podcasts I love hearing because I think they're the most honest. So there's a company here in Dallas called Alchemy that IPO'd, and I interviewed the founder at Venture Dallas, which is a conference here in Dallas that I co-founded, and he was days away from running out of capital, but he signed a contract, and that's what got things going. And then they IPO'd about a year and a half ago, right? So, you know, failure to success, I mean, it could, in this case, could be within weeks, right? So those are the sort of the stories I love hearing because they're the most honest.
Yeah.
And I think entrepreneurs have not been entrepreneurs and they just read articles, etc., they think, it's a very easy path to success, which is not the case at all. And that, and being where you are and the types of companies you invest in.
Mm-mm.
Exactly.
Yep. Lost a lot of hair. We missing pay. Getting very close to missing payrolls, and sometimes companies work and sometimes they don't. And I mean, sometimes you have to cut your losses. But yeah, no, it's definitely part of the game. Learning learning from
Yeah, and I
failure, and if
think
you could
the
just
entrepreneurs
live
in
to
your
fight another day, I
backyard
think that's huge.
concentrate on unit economics and business fundamentals that allow them to break through a pandemic, break through a recession, things like that, right? They look at those types of business
Hmm.
traits to if they did hit tough times, they hopefully can get through them, right? So very cool, David. Well, thank you for having me on.
Absolutely. Awesome. Thanks for coming on. Everybody, that is the Capital Stack. We drop an episode every Tuesday where we talk to investors, entrepreneurs, and founders about all things value creation in startups and technology. Please subscribe, share with a friend, leave a review. It's greatly appreciated, and we'll see you next week. Bye-bye.